Understanding qualification ratios, a key factor in loan approval. When applying for a loan, one of the most critical components that lenders consider is the qualification ratio. This financial metric helps assess a borrower's creditworthiness and determines their ability to repay a loan. In this article, we will dissect what qualification ratios are, how they are calculated, and their significance in the lending process. What are qualification ratios? Qualification ratios are financial indicators that lenders use during the underwriting process to gauge an applicant's capacity to repay a loan. Primarily, there are two types of qualification ratios that lenders focus on. 1. Front-end ratio, housing ratio. This ratio assesses the proportion of a borrower's gross monthly income allocated to housing expenses. Typically, lenders prefer this ratio to be no more than 28%. Housing expenses include monthly mortgage payments, property taxes, homeowners insurance, and associated fees. Text, front-end ratio, equals frac, text, total monthly housing expenses, text, gross monthly income. 2. Back-end ratio, debt-to-income ratio. This ratio incorporates all monthly debt payments, including housing costs, car loans, credit card payments, etc. Most lenders cap this at 36% but may allow a slightly higher percentage in certain cases. Text, back-end ratio, equals frac, text, total monthly debt payments, text, gross monthly income. Lenders will use the lower of the two ratios to determine how much credit they are willing to extend. Importance of qualification ratios. Qualification ratios serve multiple crucial functions in the loan approval process. Risk assessment. Higher qualification ratios indicate a greater risk of default. This prompts lenders to either request higher interest rates, require additional collateral, or deny the loan application altogether. Loan terms. These ratios significantly impact the terms of a loan, including the amount and duration. For example, a borrower with a low qualification ratio may qualify for a larger loan with favorable interest rates. Underwriting benchmark. Qualification ratios help lenders standardize their evaluation process. This consistency contributes to a fairer lending practice across various borrowers. Calculating qualification ratios, a step-by-step approach. To illustrate how qualification ratios function, let's consider a hypothetical scenario. Suppose two individuals earn a combined gross income of $96,000 annually, which translates to about $8,000 monthly. Calculating the front-end ratio. 1. Calculate maximum housing expense. 28% times 8,000 is equal to 2,240. This means the maximum acceptable total monthly housing expense should not exceed $2,240. Calculating the back-end ratio. 1. Calculate maximum total debt payments. 36% times 8,000 is equal to 2,880. 2. Subtract other debt payments. Assume the borrower has a $300 car payment and a $400 student loan payment. 2,880, 300 plus 400, equals 2,180. This means the remaining amount for housing costs, after accounting for other monthly debts, is $2,180. In this scenario, the borrower would be eligible for a loan as long as their monthly housing expenses do not exceed these calculated limits. Special considerations. It is crucial to note that qualification ratios are not ironclad. Various qualitative factors can influence lending decisions. Credit score. A strong credit history can offset a less-than-ideal qualification ratio. Lenders may extend loans to borrowers with higher ratios if they showcase excellent credit ratings and a solid repayment history. Down payments. Significant down payments can also mitigate perceived risks associated with higher ratios. For instance, a borrower might secure favorable terms by offering a substantial upfront payment. Special loan programs. Many lenders offer specialized mortgage programs that cater to borrowers with higher qualification ratios, albeit usually accompanied by elevated interest rates. Credit card debt and its impact on qualification ratios. Credit card debts significantly contribute to a borrower's back-end ratio. Traditionally, lenders calculated monthly debt as the minimum payment required on a credit card, which could skew perceptions of a borrower's financial situation. Nowadays, many lenders assess credit card debt differently, typically considering 5% of the total credit card balance as the monthly debt for qualifying ratios. For example, if a borrower has $10,000 in credit card debt, this could add an additional $500 to their monthly debt obligations. Conclusion. Qualification ratios are vital tools in understanding and navigating the lending landscape. They provide lenders with a framework to assess a borrower's risk and determine the appropriate terms for extending credit. Borrowers should be aware of their qualification ratios, as they can significantly influence their loan applications, loan amounts, and interest rates. By understanding how these ratios work and the factors that may affect them, individuals can enhance their chances of securing favorable loan terms.